want to broaden out the market conversation right now. Joining us right now is Dan Suzuki. He's the portfolio strategist at Richard Bernstein Advisors. Also, Mike Santoli is in the house, CNBC senior markets commentator, joining us now. What are you doing? Are you as negative as you like the last couple months? You've been negative.
Couple decades.
Yeah, I've been more on the cautious side. If you look at the market, I mean, Mike was talking on TV yesterday about how the market's, working hard to stand still. If you look at the market over the last 20 months, it's gone nowhere. And if you look at the performance, it's been all dominated by gold, bonds, and the more defensive sectors. So look at yesterday with the market doing actually, decently well. What are the stocks and what are the sectors that are making all-time highs? It's, consumer staples, utilities, real estate, Procter & Gamble, Dollar General. These are not signs of a really healthy economy or a healthy market. And I think that's the issue. So that's the way we're positioned.
Therefore, you recommend investors do what?
I think investors need to be taking their foot off the gas pedal, taking a little bit of risk off the table, and continuing to focus on the more defensive sectors. Now, when we tell people that they should buy defensive, the first thing that they say is defensives are expensive. But I think that that's a little bit of a misnomer. I mean, there's really three reasons why the defensive sectors are looking a bit expensive. One, they're more correlated with rates, right? So rates are near all-time lows, and that's kind of a drag. Relative to rates, actually, utilities and real estate actually look on the healthier side, on the cheaper side. Secondly, look at the fundamentals. If you look at the fundamentals for the cyclical sectors, they're the ones that are posting a negative earnings growth, like earnings contracted relative to last year. And so that's reflective of that. And then lastly, you can't really compare defensives versus cyclicals because cyclicals actually tend to look cheap when their earnings are peaking and you should be selling them.
You want to be any more optimistic, Mike?
Yeah, I mean, look, I think that there is a way to look at it, as I said yesterday, of, okay, the market has really been treading water here, and maybe it's going to get fatigued in that process. But it's hard to look at specific things that say that the market's in deep jeopardy as a whole. You have things like Microsoft and JP Morgan both touching an all-time high last week, and the market breadth underneath has been okay. What I think is interesting, though, to your kind of style and sector point is everyone got very excited about this idea that we had this cyclical and value revival. It's kind of paused or stalled, and now you have the big growth stocks kind of holding up okay, too. Nothing really changed in terms of the uptrend in growth. So all that together means the market has kind of quietly coiled itself up pretty tight right here in a very narrow range. Last week's low during Jay Powell's press conference, as a matter of fact, is really just about 1% below where we are, and we haven't touched it since. So I think right now, you could argue to give the market the benefit of the doubt for the moment in terms of being well supported. And I think only because the credit markets are so flush, and you have investment-grade corporate bond yields right now are 3%. They were above 4% a year ago, and the stock market's at the same valuation. So to me, things are hard to fall apart when that's the case, at least in the short term.
I think Mike's making a lot of great points, and I don't see anything that says the market's going to fall off a cliff tomorrow. In fact, my base case is that we'll probably make more highs between now and the end of the year. We'll probably have a 5 to 10% correction between now and the end. That's the type of volatility that people need to be aware of. In that type of environment, I think the defensive sectors will still do well. I mean, there are companies.
But you'd be buying off the bounce? I mean, you say 5 to 10%.
Yeah, 5 to 10% correction. And no, I mean, it depends on what the data is telling you at that time. I mean, there are companies that are reporting healthy earnings, but we also had FedEx, right? I mean, FedEx has company-specific issues, whether it's Amazon, TNT, all these very specific issues. But if you look, what they're telling you is that global growth is slowing, uncertainty is increasing, and the costs are going up. And so that's the type of thing that you're seeing more broadly. Mike yesterday was talking about the Chicago National Activity Index. What's interesting is that did bounce, but if you look at 3 of the 4 components, the drivers of that index were actually negative. So it was really all held up by industrial production, that part of the survey. And industrial production, if you look at that series alone, it's at like a 3-year low or something like that. So I think the data is still clearly moving to the downside. We got a nice PMI number. If that continues, I'll get a little bit more optimistic in the short term. But I think that the preponderance of the data is coming in a little bit more negative. So I don't know why you want to play a hope strategy that earnings are going to rebound tomorrow.